Hello everyone, and welcome to Financial Accounting. In today's lesson, I'm going to be going over receivables. And receivables is one of those topics that we've seen in the very first few chapters that we covered. And receivables is an asset. As you know, it's an asset that belongs to the balance sheet. What we're going to be seeing today is the different kind of receivables and how it's classified and some of the contra asset accounts, which is allowance for doubtful accounts, and how we calculate it and the reason for its existence. So now let's talk about the classification of receivables. The term receivables include all money claims against other entities, including people, companies, and other organizations. So it's basically any money that we expect to collect from either customers, or it could be other companies or any other organizations. The receivables that result from sale on account are normally accounts receivable or notes receivable. If it's a verbal agreement, we call it accounts receivable. If it's a written agreement, we call it notes receivable. Notes and account receivable that result from sales transaction are sometimes called trade receivables. So don't be surprised to see the word trade receivables in some cases. The most common transaction creating a receivable is selling merchandise or service on account, or in other words, on credit. So the receivable is recorded as a debit to accounts receivable, and we usually credit sales. So such accounts receivable are normally collected within a short period of time, such as 30 days or 60 days, and that's why it's classified as a current asset. So they are classified on the balance sheet as a current asset. On the other side, we have notes receivable, and notes receivable is whenever it's documented, whenever it's a written promise. So these are amounts that customers owe for which a formal written instrument of credit has been issued. If notes receivables are expected to be collected within a year, they're classified on the balance sheet as a current asset. Notes are often used for credit periods of more than 60 days. They also may be used to settle a customer's accounts receivable. So in many cases, we'll see a customer who couldn't meet like 30 days or the 60 days of the accounts receivable expected period. So if they can't pay, they just sign a note and they will get like an extension. And in this case, they usually pay an extra amount of interest on top of the note's value. So what other forms of receivables? We can see things like interest receivable, tax receivable, receivables from officers or employees. Of course, these are not very common. Maybe interest receivable is one of the common ones. Other receivables are normally reported separately on the balance sheet, so we don't mix it with accounts receivable and the notes receivable. So if they're expected to be collected within 1 year, they're classified as current assets. If collection is expected beyond 1 year, these receivables are classified as non-current assets and reported under the caption investments. So this is something that maybe we haven't seen before, like this kind of title or caption investment, which is basically any kind of long-term investment. And in this case, if the note is not expected to be collected within a period less than a year, then in this case we put it in the category of investment. One of the major problems with receivables is that sometimes these receivables cannot be collected. And there are many different reasons that we'll see that lead to receivables not getting collected. The simple thing is people file for bankruptcy, and if they file for bankruptcy, they're not going to pay their accounts receivable, or on their side would be their accounts payable balance. So a major issue of selling merchandise or service on account or on credit is that some customers would not pay their accounts. That is, some accounts receivable would be uncollectible. So we have to expect that. That's part of the business, and this is why this is part of our what we call it bad debt expense. So we offer a sale for a customer on account or on credit, and that customer doesn't pay. When they can't pay, then we expect that this is going to be part of the business or part of the business expenses. So companies may shift the risk of uncollectible receivables to other companies by not accepting sales on account and only accepting cash or credit cards. And many businesses do that. They don't offer credit. And if they don't offer credit, sometimes they lose sales. So companies may also sell their receivables, which we call it factoring. So the buyer of receivable is called a factor. An advantage of factoring is that the company selling its receivable immediately receives cash for operating and other needs. The problem with factoring is that you never sell the accounts receivable dollar for a dollar. It's usually like for lower value, because the factor is the one who's going to bear the risk of not collecting the receivables. In some cases, they can transfer this risk to us, and in this case, we can collect a little bit more than like a fraction of the price. So let's say it's 80 cents per dollar. Maybe if we're bearing the risk, then it could be 90 cents per dollar. So regardless of how careful a company is in granting credit, some credit sales will be uncollectible. So many businesses are extremely careful before they offer credit to any of their customers or clients. So what they do is that they run their credit history and do these kind of checks, and then yet there's some people who are not paying their balance. So the operating expense recorded from uncollectible receivables is called bad debt expense, uncollectible accounts expense, or sometimes we call it doubtful accounts expense. However, the most commonly used term is bad debt expense. Most people understand that bad debt expense is the expense of people not paying their debt. Some indications that an account may be uncollectible include the receivable is past due, so it has to be paid within 60 days. Now it's day 70 or 80 and the customer haven't paid, or the customers haven't paid. The customer does not respond to the company's attempt to collect. So we're sending them emails, we're sending them letters, we're trying to call them, they're not responding. The customers file for bankruptcy, and again, this is not a very good indication. The customer closes its business, or finally the company cannot locate the customer. Sometimes people, they leave the country or they simply die. The two methods of accounting for uncollectible receivables are the direct write-off method and the other method called allowance method. The direct write-off method is easy, it's simple. However, it violates generally accepted accounting principles. The allowance method, it's a little bit more complex, not extremely complex, but it's a little bit more complex, but it satisfies GAAP. So it meets the requirements of GAAP. So the direct write-off method records bad debt expense only when an account is determined to be worthless. So when we know that we cannot collect this balance, we record the bad debt expense. So the direct write-off method is often used by small companies and companies with few receivables. And in this case, GAAP would let it go, would accept it. If you're a small business and you don't have a lot of accounts receivable balances, then you can use the direct write-off method. The allowance method records bad debt expense by estimating uncollectible accounts at the end of the accounting period. So we make an estimate. Let's say we made $1 million credit sales. We expect that 10% of this is not going to be collected. So $100,000 is going to be our bad debt expense. So why we do that? To satisfy the matching principle. So that way we can record the bad debt expense in the same period we generated the revenue. Unlike the direct write-off method, we usually wait until the customer doesn't pay, and then when we know that they're not able to pay, in this case we record the bad debt expense. That could be in a different period, and that violates the matching principle. Remember, the matching principle is when we match revenues and expenses of the same period. So, generally accepted accounting principles require companies with a large amount of receivables to use the allowance method. So if you're a company that deals with credit or offers credit for its customers, then you have to use the allowance method. So let's see the direct write-off method for uncollectible accounts. Assume a 4,200 account receivable from DL Ross has been determined to be uncollectible. The entry to write off the account would be straightforward as follows. So on May 10th, when we know that this person is not going to be able to pay, we simply debit the bad debt expense. You can see here that we are debiting bad debt expense, and we credit accounts receivable. Bad debt expense, it's an expense that would appear on the income statement as one of the regular expenses. And then when we credit accounts receivable for DL Ross, we are reducing the amount of accounts receivable, so we expect that this amount to go lower. So this way we are removing that $4,200. We don't expect to collect it in the future. So an account receivable that have been written off may be collected later on. Sometimes people, they can't pay it right now, and we thought they are bankrupt, they're not going to pay the balance anymore. And then for some reason they were able to come back and do some business, and they want pay back their balance. So in this case, we have to reverse the bad debt expense that we just had. So the account is reinstated by an entry that reverses the write-off entry. The cash received in payment is then recorded as a receipt on account. So let's see how that happens. So assume that the DL Ross account written off on May 10th is later collected on November 21st. The reinstatement and receipt of cash is recorded as follows. We're going to debit accounts receivable and credit bad debt expense. And as you can see here, we just reversed the journal entry that we had on May 10th. So if I go back a couple of slides here, you see that we debited bad debt expense and credited accounts receivable. Now we did the opposite. We debited accounts receivable and we credited the bad debt expense. So why we're doing this? We want to reverse the position or the journal entry that we created on May 10th, as if nothing happened. And now we record the collection of the cash. So we're going to debit cash and credit accounts receivable right away. So some people would think, oh, so why we're doing this? Why don't we just debit cash and credit bad debt expense? Since we have debiting of accounts receivable and crediting accounts receivable at the same value, I say you can do that. You can do that, and many accountants can do that. But I think to just follow what happened, it's better to just show that you're reversing the direct write-off of your accounts receivable, and then on the second journal entry, you're showing the collection of the accounts receivable. So let me stop here. In the next video, we're going to be going over the allowance method for uncollectible accounts, and we'll get more details about that.